Well, kia rana, tātou katoa, tēnā koutou katoa. Welcome everyone. It's good to be here, a privilege to be here. Before outlining our news today from the Reserve Bank, I just do want to acknowledge that it's Armistice Day, the day that marked the end of World War I in 1918, in which 16,700 New Zealanders died and over 40,000 were wounded. So lest we forget. I also do want to, on a slightly more upbeat note, say Martini Mamanu Karapati Whai. Many hands make light work, and I say that I want to thank all of our MPC members, the Reserve Bank staff, and also a wide range of people from outside of the bank, bankers in particular, who have offered us considerable assistance and advice around some operational issues that we are talking about today. And in that spirit as well, I want to do a special thanks to Vanessa Rayner, who's sitting here in front, who has been leading our financial markets team at the Reserve Bank. Kia ora, Vanessa, for all of the mahi you have done. Up here on stage with me are the fortunate folk, Jeff, Christian and Jung. They are my fellow internal Reserve Bank Monetary Policy Committee members. Bob Buckle is in the audience here, but Caroline Saunders and Peter Harris also joined us. We had a full house throughout this period. So again, me taki ma'ata, thank you very much for your insights and efforts. It's been a busy day for everyone in the room here. Media in particular, given that we've made announcements across three of the main tools that we use here at the Reserve Bank of New Zealand to meet our mandates of both financial stability and also our monetary policy mandate around ensuring low and stable consumer price inflation and that we contribute to maximum sustainable employment. So what have we been doing? We've announced just recently that further monetary stimulus is to be provided via a new funding for lending program. The additional stimulus is to ensure that we meet our monetary policy remit, that is of the low and stable consumer price inflation, while contributing to maximum sustainable employment. We've also announced that the banking sector will be provided more time before having to rebuild their capital buffers, and we did this to ensure that they can remain focused on providing credit into the economy, supporting an economic recovery. And lastly, in fact it wasn't amongst other things, but importantly, we announced we will be consulting on reintroducing our restrictions on high-risk lending in the housing market, and that is aimed around our financial stability remit. So the three decisions together are really there to ensure that we have our best opportunity at ensuring ongoing financial stability through limiting high-risk lending, while also meeting our monetary policy mandate of low and stable consumer price inflation and contributing to the maximum employment. Elaborating on this afternoon's decision with regard to monetary policy, the committee agreed to provide additional stimulus to the economy. They saw it as necessary to meet our remit. The committee also agreed that this additional stimulus would be provided through this new facility, this funding for lending program, and that would commence in December. The idea is that the program will reduce banks' funding costs, which will then lower interest rates to the economy as a whole. The committee will also continue with the large-scale asset purchase program, up to $100 billion, and we are retaining the official cash rate at 0.25%, and that of course is in accordance with the guidance we provided. Feels like a lifetime ago, but it was only March 16 of this calendar year. It's good that progress has also been made on the bank's operational capability, ability to deploy a negative OCR if necessary, and the bank the committee agrees that all of these instruments are mutually supportive in bolstering economic activity as and when necessary. So we have a broader range of instruments providing more optionality for our monetary policy. Economic activity since our last monetary policy statement in August, we've seen both domestically and internationally has been more resilient than earlier assumed. In New Zealand, this trend has been evident across a range of indicators, including employment, household spending, GDP itself, and asset prices. These outcomes do reflect the effectiveness of the health and economic policy responses to this significant COVID shock. The COVID-19 shock to the economy is very large and persistent, and inflation and employment will remain below the remit targets for a prolonged period of time. So these outcomes are despite the current significant fiscal and monetary stimulus. In particular, the outlook for the global economic activity continues to remain dependent on the virus itself, on the containment of the virus. While recent news on vaccine developments is positive, there remains a long and uncertain lag before any widespread vaccine deployment may be achieved. Meanwhile, international border restrictions will continue to curtail international trade and migration, and this is going to have variable impacts across regions in the world and across industries within Aotearoa New Zealand. International prices for New Zealand's exports have remained resilient, although the export returns coming back to New Zealand have been partly offset by the New Zealand dollar exchange rate. Domestically, fiscal stimulus remains very significant, that is even with the wage subsidy scheme having now run its course. Government spending on businesses assistance, on household income support remain very high, and government investment will rise. But we still expect an ongoing increase in unemployment and as the economy adjusts to this shock. Consumer price inflation is also projected to remain at the low end of our remit target range, and that's for a considerable period, and inflation expectations remain subdued. On balance, with all of this taken on board, the committee agreed that the monetary policy will need to remain stimulatory for a long time to meet the consumer price inflation and employment remit, and that it must remain prepared to provide additional support if necessary. Again, Meitaki, that's it from me. We are open to questions. Thank you.
Thank you. I'm Junaid Tibshirani from interest.co.nz. Just wondering why the bank isn't considering reimposing those LVR restrictions earlier than March, given the sort of great, massive house price inflation.
Yes, I mean, good question. I mean, the first thing is without doubt, we expect banks themselves to be the ones who are lending responsibly and managing that capital allocation and avoiding undue risk. The second bit around our regulatory response, it is about as fast as you can if we are doing due and proper process. So we must consult because we're putting on restrictions, and that consultation has to be open and frank, and then banks themselves have some particular systems to do. But I would say I could imagine banks have already heard the message around we are prepared to consult.
Could you just talk us through the sort of logistics of being able to put those restrictions on? I note that when they came off quite quickly, so why is more time necessary to put them back on?
In a really simple sense, when we are taking away restrictions, we don't have to consult. When you're adding restrictions, you do. And when you're adding restrictions, there's a due process to go through around the consultation as to the business case as to why we are imposing a restriction on someone's behaviour, the net benefit we see from that, and then once a decision is made based on the feedback we get, then actually implementing that decision within the banking system themselves. They have to allow the pipeline, Jeff?
Yeah, maybe just to add to that one of the major periods of implementation pathway is applications already in process. So banks need to know how they're going to handle those and work those through. So otherwise you'll be changing rules on people already who applied, already had approvals and so forth. So they need a period of time to work those through. Obviously get messages and rules out to the front line, and it just takes a while to deploy that. And then of course we've got Christmas and a New Year period in between and all of those things as well. So it's really as early as it could be done.
Hey, this is Praveen from Reuters. Just to follow up on that question, the housing market clearly seem to be benefiting from this sort of low interest rate and low restriction environment. I just wanted your thoughts on what do you think about the market and how it's going, and is there a concern that something like the FLP would increase that kind of activity?
Yeah, thank you. I think it's really important to understand that we are doing what we're doing today and always for the purpose of the Reserve Bank's mandate and operating within its remit. And that is about making sure consumer price inflation remains somewhere between 1% to 3% per annum on average, and that employment is near, as best can be, its maximum sustainable level. And that is what's driving our action today. Around the loan-to-value restrictions and what we're consulting on, the other mandate is to ensure financial stability, and we have seen a marked acceleration in higher risk loans, particularly to investors in the property market. So it is around that high risk loan. So our targets are consumer price inflation and employment, and our financial stability for the LVR is about higher risk loans being made sure that they don't cause unnecessary long-term problems for the institutions.
Stephen from Wall Street Journal. Your economic outlook is a lot less pessimistic than it was a few months ago, even a couple of months ago. And you've said that you would rather do more than do less than was necessary. But are you now at the point where the more that you are doing is actually going to risk causing some serious problems for the economy down the track?
Our economic projections are consistent with us best meeting our mandate. And I won't repeat the mandate because I think I've said it about 5 times so far in the press conference. It's probably sunk in. But we are doing it with our best efforts to maintain that low and stable inflation and maximum sustainable employment, whilst also having regard to financial stability. Around the balance of risks, I would say, first of all, our proposition that our projections are significantly more optimistic. I think you said we are definitely starting from a better position than we were because the economy has proved more resilient to date. But that position is still from a severe negative starting point where we have had a minus 12% GDP shock and we've seen unemployment rise significantly. But we haven't seen it as bad as some scenarios could have been to date. Looking forward, it remains a projection based on scenario assumptions, and we want to retain optionality in everything we do. And we think at this point it still is important to make sure that credit is widely available, to make sure that business, investment, spending, employment is promoted.
Provide any information yet on how much money you might lend through funding for lending or what the rate will be. Are you waiting for more information to make those decisions, or can you say what your thinking is on that?
You want to elaborate?
Yeah, I can speak to that. So the funding for lending scheme, there are two allocations. One is 4% of eligible loans of eligible banks, and there's an additional allocation of 2% if the banks meet particular lending targets. By our measure, that will add up to around $28 billion if that full allocation, both the initial and the additional, is taken up. But from our perspective, we've focused less on the size of the program and more, we think the key thing is the impact that the program will have on interest rates and how it will give banks confidence to lower their other funding rates, term deposits and wholesale funding rates, and enable them to pass that on into lower business and wholesale household lending rates. And that's really how we'll be measuring the success of the scheme as opposed to the size and scale of the take-up.
Is it fair to say lately you're seeing more pass through to deposit rates than to lending rates? And are you happy with both legs of that assertion, if it's true?
There certainly has been a lag from the wholesale through into the retail lending rates. I mean, it doesn't happen overnight, but it eventually happens. We expect to see, we know that banks have largely front-run today's decisions, particularly after we announced that the Monetary Policy Committee instructed the bank to work on this funding for lending program. So we've seen some movement there, but one certainly expects to see that pass through to be full and wholesome in December when the program's up and running.
Yeah.
Is it of concern to you that depositors now face negative real returns?
We operate monetary policy for all New Zealanders, and we have the tools that we have, which can be generally blunt, and there are unders and overs through that, through business cycles. So it is what it is. I would remind people that we are in an extremely low global inflation period, something that we haven't experienced through most of the working population's life. And so it's the new world. It's what we live amongst.
Giles Beckford, Radio New Zealand. Does the bringing in of the funding for lending program, the prospective move back to LVRs, does that decrease the probability of a negative interest rate, or just where does that lie in your thinking now?
It's too early to tell. We want to leave all options open, and we'll be revisiting that decision at our next Monetary Policy Committee, which is in February in the new year.
Rebecca Howard from Business Desk. It seems like the most bank lending seems to be going into the housing market as opposed to into business. So is there anything in the funding for lending program that encourages banks to lend more to business?
Christian, do you want
Yeah, so no, there is nothing particular that targets that lending into businesses. There is an additional initial allocation which is based around the balance sheet of the bank at the start of the period, and an additional allocation which is related to both wholesale and business lending. So to some extent it does work in through that factor, but it sits side by side with the household lending that the banks do. We've looked pretty hard at international experience, and what we've found is that the most powerful channel that these funding for lending programs can work through is this ability to give banks confidence to lower those interest rates. And the more conditionality, the more complicated these schemes get, the less they get taken up and the less effective they can become. There are some schemes that do have particular focus on business lending, and we've found that that's typically when there's a specific blockage that's being addressed. At the moment, we think subdued business lending is largely due to just economic uncertainty, and we think supporting the economy is the best way to resolve that.
Bernard Hickey for Stuff and a few other things. Could you explain what conditions there are for the funding for lending program to ensure that certainly the first 4% doesn't just get captured by the banks as lower funding costs and higher profits, and they don't actually lend any on?
I mean, one, at the margin, although we don't think this is a big part of the deal, they get another 2 if they are good citizens and pass it on and do what they're meant to do. The second part is transparency, where we will have to watch very, very carefully. I have to say, with the funding for lending program, and Yung may want to chip in, we have much higher confidence around it being passed through because of the broad base that it hits across all institutions and the impact it has on I would say, sources of funding for banks. If you've got this lowest cost sourcing, knowing that it's at OCR, it's very hard to wonder why you wouldn't be using that and passing it on. But Christian,
I think that's bang on. It's just that we will be monitoring lending rates very, very closely, and we have a very high degree of confidence that it will be passed on.
Thomas Coughlin, Stuff. Do you feel like you made a mistake taking LVRs off in the first instance, and also, given that they were meant to stay off for at least 12 months, what degree of confidence can we have in other decisions that you've given a forward time frame for, like the OCR at 0.25?
Yeah, great question. So around the official cash rate, I can only restate that we, and again, that we are sticking to what we said back in March, that the OCR would remain at 0.25% until next year, and we're pretty close to next year now. In fact, we're not out talking prior to that anyway, so you might not have to rely on my word. It's a mere fact of the calendar. On a mistake or not of the LVRs, no, I have no regrets with what we did. We made sure during the darkest periods of the COVID uncertainty that there was nothing that we were doing, the Reserve Bank, that would get in the way of banks being able to step up and provide confidence and cash flow. And we had significant concern that the mortgage deferral scheme, for example, may run up against our own loan-to-value restrictions. And so that's why we removed them in haste. A lot of those issues have since passed, and that's why we're now talking about having them back on. I will say we don't have a long-term position yet, which we still need to do around what is a steady state level for LVRs now and into the future. Is it no LVRs, or is it some LVRs at some level permanently? So we are where we are today. It's not a permanent, and we'll be consulting for something that's not a permanent state.
Yeah, Tom Bullostraker from Stuff again. Just to clarify that last answer, I mean, the commitment, as I recall it, that was given in this room was to keep the OCR fixed at 0.25% for 1 year.
Yep.
From March when you made that commitment.
That's
so
right.
Just to check, you're not bringing that forward to sort of January or February.
Well, we're not bringing it forward, but we're next considering monetary policy in February.
Oh, okay, so
our commitment stands.
Change in February, or is that
I don't
March?
know. I'm not in February. Our commitment stands.
But the commitment, can you confirm the commitment?
Our commitment stands
for
to
1
not
year
move
from March,
Yes.
so to March next year to keep the rate at 0.25%.
People want to say yes as well because he's not listening to me. He's, do we have a collective, some kind of wave?
The committee's guidance stands.
Yeah, and at every single OCR decision that we've had every 6 weeks since March, as part of the statement, we've said we're keeping the official cash rate on hold.
Coming back
consistent with that guidance, and that's how we've communicated it every time since then.
Coming back to Thomas's question about you break one promise and you're now untrustworthy. I'd have to say around these issues was a really hard decision, not on the economics but on that issue. It was a lot easier decision given that both in person and certainly in public, and then via third parties, i.e. the media, I've had almost every bank CEO and many of the bank chair people asking us to put them back on. You'd have to ask the banks why they couldn't do it themselves, but I assume that is because of the competitive nature of banks. No one bank felt they could afford to step out from the LVRs at the levels they were lending to for fear of losing market share, so the traditional call came for us to do it to them instead. So in terms of disappointing people, it's not the bank CEOs.
Me again. There's a really strong emphasis on the employment mandate in this MPS. Can I ask you, if you did not have that mandate, do you think the decisions that you've made in the last year, essentially, would have been substantially different?
No, I think, and I can say that very easily in the sense that both inflation and employment are south of where they are on our mandate. So there is no trade-off having to be considered here. It is very clear monetary conditions have to be stimulatory and considerably stimulatory. A real concern around inflation expectations and global inflation. We spent a lot of time, and I hope it was reflected in the record of the meeting, talking about the challenges of having higher than anticipated inflation and being able to control that temporarily, versus the alternative where you have falling and if not deflation, and the difficulties of returning back to a small but positive inflation rate. And so our experience and our confidence is we'd prefer if there was going to be an error made, not on purpose, but if there was going to be an error made, it would be higher than otherwise inflation as opposed to the alternative. The other part of why we talk a lot about employment is because it really matters. And all I ever read about with monetary policy is house prices, yet that's not our mandate. And I'd ask the journalists to kind of reflect on that. In fact, my colleagues talked about the fact there's something like 3 house price indices that come out monthly, which means 9-to-1 reports on house prices versus unemployment, which is fascinating for newspaper clips and clickbait, but it's not in our mandate. Our mandate is inflation, consumer price and employment.
Governor, there's no change in the large-scale asset program here, 100 billion. But last time there was a acceleration or a pulling forward of the program. Is there any further change in the pace of buying, given that we saw yesterday the government's Crown accounts are healthier than was expected at the prefu? And in theory, they wouldn't need to buy so many bonds. The core question is, are there going to be enough bonds for you to buy?
Answering your last one, yes, and the other one, business as usual.
Very small adjustment this week. We put out a schedule every week, and there was a small adjustment this week. We're currently at a run rate which puts us, if we keep at this run rate, we would reach that 100 billion limit. It's not a target, and we'll keep adjusting that scheme and the weekly purchases as we see fit. The MPC endorsed the staff's plan, and there's a lot of flexibility within that.
Ben McKay, Australian Associated Press. Governor, I'm just wondering, a lot of focus on your meeting with Grant Robertson this week. To the extent that it's appropriate, what are you talking about? What's the intersect of your thinking?
That we make sure that we operate on a no surprise basis, actually on the day, once the decision is made. So I have a call with the Minister, and the meeting this week was really around what is going on around the broader policy settings so that we are aware here at the Reserve Bank of New Zealand. All decisions you hear that we're announcing today and earlier are the decisions of the Reserve Bank and only the Reserve Bank under our mandate.
Matthew Brockett from Bloomberg. In terms of the impact of the FLP, do you have an estimate for how many basis points you would expect it to knock off mortgage lending rates?
No, but we think it's larger than shifting the OCR from 0.25 to 0.1 a la the Reserve Bank of Australia. So we think it's a significant impact. We hope it is as big as possible, i.e. that the banks actually follow through and deliver on lower interest rates.
Secondly, your forecasts show a sort of another mild recession starting in the current quarter. Are you able to provide any sort of thinking on what's causing that?
Yeah, I can bring Yung in. Greetings, Yung.
Yeah, hi. It's basically volatility in the data, right? So we're in this unprecedented time when we had a massive decline in GDP in quarter two. We'll equally see a massive bump back up, and then you've got a whole bunch of policies that are running off. So in a scenario model basis, you get some wobbles in the GDP data, and that's how it's showing up. But the broad picture is one where the economy is in a slightly better starting point. It's still a big hole that we're climbing out of, and it will take a while for the economy to recover, underpinned by incredibly stimulatory fiscal policy and monetary policy.
A general comment, we are going to go through we are amongst an incredibly noisy period of economic data given the unprecedented nature of the shock. And the pluses and minuses and swings and roundabouts are going to be very large, and the Reserve Bank remains focused on the medium term views of what matters for us.
Janae Tibshirani again from interest.co.nz. There have been some calls for the Reserve Bank's mandate to be changed for it to be made to consider asset price inflation as well as CPI inflation and employment. Obviously, this is not a decision for you to make, but what are your thoughts on that?
We'd have no comment. That's as you rightly say, it's not our decision. We operate with our mandate.
If the finance minister said this is what I'm doing, what would your feedback be to him?
Hypothetical.
I was just going to mention that we, under the Reserve Bank bill, or actually it may even be in the current act. It's in the current act. We're required to have a remit review every 5 years. So, that will be the Reserve Bank's advice as well as Treasury's, and then ultimately the Minister's decision on how a target should be specified. So that sort of issue would get considered at that time, whether it's still appropriate, and you always have those discussions about the CPI, what it's measuring, is that the right target for inflation and so forth. So I think over the next few years there's opportunity for research and thought about that.
And, asset prices, as we talk about in here, it's really, with regard to monetary policy, it's really about how wealthy or not people are feeling, and hence whether they are more or less prepared to consume out of that wealth. So that's where it comes in directly, and that's broad asset prices on the way through. And the financial stability component in terms of loan-to-value ratio really is around whether there are unnecessary high-risk loans going on that can lead to further problems down the path.
So just on that remit review, would some of the advice that you would give in that remit review be around the inclusion of house prices? And
I don't know. I haven't heard what Jeff's views are.
No, potentially. I mean, you just have to consider a number of things of what's an appropriate target, what we can achieve, what's effective, what the best practice internationally is, and so forth. And it's a continual debate, really, as to.
The one thing the Reserve Bank has been missing, which several central banks do have internationally, is this opportunity every 5 years that it's a public review on, are we aiming at the right things? And that's, the Bank of Canada has been doing it for several rounds now as one example. And these issues continuously get talked about. By the way, they continue to operate as we do.
Your comments before about the frustration around housing and the criticism that you're getting around.
I'm not frustrated. I was pointing out,
right. Is that something that you raised perhaps in your meeting with Grant Robertson this week? Is there a frustration about the lack of support on the other side of the equation in terms of? I mean, you've mentioned the MPS as well around the regulatory issues around housing, around some of the fiscal stimulus, and potentially not being enough to support higher incomes and etc.
Yeah, very good question, Thomas. Around this, and we made an effort. I wouldn't say a particularly special effort, because there has been pages and pages and books and documents written on the problem definition of New Zealand housing market, which is largely a supply-driven challenge, around which also increased immigration added to the excitement we have been observing over recent years. And I think the New Zealand Productivity Commission's study, which sounds quite dated now, way back in the 2010s, noted that of the 10 things that were most driving these behaviours, the level of interest rates weren't mentioned. So there are so many other factors going on around which we all talk about, and none of them are here in the Reserve Bank. Those of the factors we talked about, the productivity. The interest rate, without doubt, will alter asset prices, or amongst many other things that will alter asset prices.
Governor, the IMF chief economist said last week that governments should step up with more fiscal policy to help out the central banks who are sort of near the end of their ammunition piles. Do you think that the government could perhaps do more on the fiscal policy side, particularly with more direct payments to those who would spend all of their payments? Or do you think the fiscal policy, monetary policy balance is about right?
First of all, we feel very well supported by fiscal policy in this country. The IMF do sweeping statements about the globe as a whole, and without doubt most other countries in the world are in much deeper problems than we have here in Aotearoa, New Zealand. So I'm not sure that that sweep of the arm was directed actually at us. With fiscal policy itself, that is a government issue. It's not us. So we play the hand that is dealt, and at the moment we feel well supported on the monetary and fiscal policy information flow and activity. One of the uncertainties that we put in amongst many in our scenarios is the delivery of the announced fiscal spend, because that's an important component of the overall economic activity.
The Federal Reserve and the Reserve Bank of Australia, and I think the ECB, have started to talk about using average inflation over the longer run rather than, in the next couple of years as their target, i.e. letting inflation rise perhaps more than they normally would, just to get a bit of heat back into the engine, so to speak. What's your view on allowing inflation to get a bit higher, just to clear away from the ground of low inflation expectations?
I'd probably say two things, and I'll pass it over to Yung. He can warm up. The first one is welcome to those central banks to how we operate monetary policy. We've always talked about on average over time. We have a broad range, and that's exactly the activity. In the current position, under the current circumstances, given where the starting point is on inflation, given the uncertainties are still skewed to the downside based on the many assumptions you have there, if we have to make a mistake, we'd prefer it to be north on the inflation rather than south on the inflation. But that's where we are.
Yeah, I guess it speaks to the challenge that central banks have of trying to fight persistently low inflation and weak economic activity. How do you give confidence that central banks are truly committed to their mandate and trying to find different ways to express that? I guess that's part of the evolution of the words that some of these central banks are now exploring.
So one thing we know about central banks globally, they have proved highly effective at fighting inflation from high to low. We don't have a great track record to date of fighting it from very low back to something within their mandate, hence that balance of risks that are being talked about globally. And we go to some length around discussing inflation expectations in our document. I'm very pleased to see very long-term inflation expectations well anchored on our 2% mid-range, but the shorter-term inflation expectations take longer and longer and longer each time they've come out recently to actually get back there. And so, we don't want to be kind of caught in that never quite getting there syndrome. Thank you. One last question, thanks.
I know sort of similar questions have been asked before, but at what point does house price inflation compromise financial stability? I don't know if you can sort of pluck a figure out in terms of the type of inflation that...
Can I say that it's not house price inflation, it is the amount and level, proportion of high-risk loans that we are concerned about. High-risk loans are the ones where you are very leveraged and you might have a small shift in your employment status, your household income status, the interest rate or the price that you're paying, and you suddenly can't afford that, and that could happen if whole of unemployment rises, and it happens across a broad swathe of homes who are highly leveraged. It's at that point you have a financial stability concern. I can't tell you what house price that is. I can tell you about the leverage that is going on into bank balance sheets. So that is our concern, not house prices. We observe house prices like everyone else does. Thank you. Thank you very, very much for all your questions and good luck. Thanks, team.